Hello and a warm welcome. You've joined us here on Market Cafe right here on ET Now. I'm Ashesha Adwari, and first up, let's take a look at what US markets were doing in yesterday's trading session. While Indian equity markets were shut in trade yesterday, we had little action that came in from US markets. Dow Jones, in fact, ended absolutely flat, and all three US indices continue to trade at record high levels. We had Dow Jones, which ended absolutely flat. We also had S&P 500, which ended 0.6% higher in trade yesterday. And NASDAQ too ended nearly 0.9% higher. Now remember, investors are awaiting Iran deal confirmation, and on the back of that, we have seen some optimism that has come in for global equity markets. Focus, of course, has been on potential 60-day ceasefire extension, and if at all that comes through, it will be a big positive for global equity markets. In terms of individual stocks that were in focus today, of course, all eyes were on IT stocks in yesterday's trading session. Other than that, we also had a lot of action within the US equity markets. When we talk about Qualcomm, AMD, all of them gained nearly 4% in yesterday's trading session. Healthcare, technology and discretionary, these were the three segments which aided gains for US equity markets yesterday. Meanwhile, as far as the US futures are concerned, let's also put the spotlight on that. NASDAQ 100 futures are sitting with a cut of 0.2% as we speak. S&P 500 futures slightly down with some bit of negative bias, and Dow Jones 100 futures are also sitting absolutely flat in today's trading session. Meanwhile, let's also shift focus to commodity markets then, and we have the oil market has just cooled off now on account of a potential deal that could happen between Iran and Israel, and on the back of that, Brent crude is now trading at $93 per barrel. That's WTI crude for use, trading at about $88 per barrel mark. In fact, crude currently, as I mentioned, is at 88, and gold prices meanwhile have inched higher on the back of optimism that perhaps a trade deal could be signed. And on the back of that, gold is up 0.2%, silver is up 0.7% in trade today, and dollar index is now trading at that 99 mark. It is below that 100 mark and currently trading at that 98.9 mark. Meanwhile, let's also take a look at what Asian markets are doing this morning, and it's a mixed bag that has come in from Asian markets. Shanghai is sitting with a slight bit of negative bias, but on the flip side, we have Hang Seng, that's the Hong Kong index. That index is up 0.4%, and Nikkei, that's the Japanese market, is also sitting with gains of nearly 1.5% in trade today. So clearly mixed picture coming in for Asian markets this morning. And GIFT Nifty is suggesting a slightly muted start for Indian equity markets. Nifty implied open is now sitting with a cut of more than 100 points as we speak. But let's shift focus to some global stories then, and the US and Iran have reportedly reached a framework agreement to extend their ceasefire by another 60 days and reopen shipping through the Strait of Hormuz. Though final approval from US President Donald Trump and Iranian leadership is still pending. The proposed deal has boosted hopes of easing tensions in West Asia, with oil prices falling on expectations of smoother energy flows through one of the world's most critical maritime choke points. Shifting focus to a couple of other stories then, US inflation came broadly in line with expectations in the month of April, offering some relief on the price point. Core PCE, the Federal Reserve's preferred inflation gauge, rose about 0.2% on a month-on-month basis and 3.3% annually, while headline inflation stood at about 3.8%. However, softer inflation data was accompanied by weaker economic growth, with first quarter GDP revised downwards to 1.6%, reinforcing expectations that the Federal Reserve will maintain cautious stance amid a slowing economy and persistent inflation pressures. Shifting focus then, two Federal Reserve officials struck a cautious tone on inflation. Chicago Fed President warned that the Iran-linked energy shock has lasted longer than expected and is creating an old-fashioned stagflation shock for Asia. Meanwhile, Minneapolis Fed President Neil Kashkari said inflation remains Fed's top concern despite a healthy labor market, adding that policymakers cannot risk inflation expectations becoming unanchored. Moving on then, shares of Ferrari remain in focus after CEO defended that €550,000 price tag of the company's first fully electric vehicle, the Luce. Vigna said that EV represents a new chapter for Ferrari and cannot be compared with the mass market electric vehicles. While the launch triggered an initial sell-off and criticism from the former chairperson, Management says customer interest remains strong, including from new ultra-wealthy buyers. And oil markets may be underestimating the severity of the ongoing supply disruption. That's the word coming in from ExxonMobil. Senior Vice President Neil Champion warned that global crude oil inventories could fall to critically low levels within weeks, potentially triggering a sharp spike in physical oil prices. Exxon believes Brent cargo prices could surge to $150 to $160 per barrel if inventories hit record lows, despite futures market currently pricing in optimism around a potential US-Iran deal. Shifting focus then back to domestic cues then, Union Commerce Ministry has confirmed that US team will visit India from the 1st to 4th of June to finalize details of the trade pact and take forward negotiations. Sumita is now joining us with more details on this.
That's right. The US-India trade deal is once again in focus as a delegation from the United States is going to be visiting New Delhi from the 1st till the 4th of June to further talks on the bilateral trade agreement. And this is being confirmed by the Commerce and Industry Ministry here in India. In fact, the US team will be led by Chief Negotiator Brendan Lynch. And of course, that is under the USTR. And it is proposed to finalize the details of the interim agreement and take forward the negotiations under the broader bilateral trade agreement. In fact, discussions will be happening on market access, non-tariff measures, customs and trade facilitation, investment promotion, economic security alignment, and several others. Remember, the India and the United States, both of them issued a joint statement on 7th of February 2026. Both of them agreed on a framework for an interim agreement after the United States Supreme Court it termed these tariffs under IPA as illegal, and after that 10% tariffs were imposed by the Donald Trump administration under Section 122 that replaced reciprocal tariffs. And after that there was an understanding that the deal stays, we want to stick to the deal, but then of course negotiations had to be restarted. So in April is when the Indian side visited Washington DC from 20th till the 23rd of April for an in-person round of meetings led by Darpan Jain, India's chief negotiator for trade talks. And this visit, remember, by the US administration has been in the offing as both the sides are looking at finalizing the legal agreement. This has also been hinted at by USTR Jamieson Greer a couple of hours back. What is India pitching? Well, for a lower tariff rate while ensuring market access and a balanced trade deal. India also wants a resolution to investigations related to Section 301, and sources told ET Now a couple of days back that India has submitted its representations to the US side on investigations that are related to Section 301, and that is something that India is expecting the United States to address as well.
Sumita, thanks so much for joining us with all those details. But on that note, we need to slip into a very short break. More news and updates will continue on the other side. Welcome back. HDFC Bank has rejected allegations that are linked to an alleged camouflage of additional interest payouts, saying assumptions and wrongdoings are based on selective use of material. Ankur is now joining us with more details on this.
Yes, in a response to ET Now, HDFC Bank has rejected any kind of wrongdoing based on the selective material. The bank has clearly mentioned that bank has robust internal oversight, audit and control processes and systems, and the bank is also saying that all issues are dealt as per the established norms and due processes are followed before any final determination. Now, what was the issue? The allegations were that on an arrangement which was there with MSRDC, there were allegations that camouflage has been done on part of the bank, whereby there were arrangements where the interest rates on deposits were much more than what was the normal policy of the bank, and an arrangement was made that based on the marketing expense that over and above interest arrangements were made. The ask for the MSRDC was around 6%, whereby the bank norms were allowing only around 4%. Therefore, the differential was paid as per the marketing expense, and these are the allegations which were there on the bank. Now the bank is clearly saying that there is no wrongdoing on their part. However, the bank has been in the eyes of all the investors ever since there was a resignation of Atanu Chakrabarti, citing the concerns which were there in the letter, and after that these allegations also came, which bank has clearly denied for now.
Ankur, thanks so much for joining us with all those details. Shifting focus then, and in a landmark verdict, the Supreme Court has upheld the levy of 28% GST on online real money gaming, including retrospective taxation before October 1, 2023, delivering a massive blow to the gaming industry. The court ruled that GST will apply on the full face value of bets and contest entry amounts, and observed that even skill-based games require the character of betting once money is staked on certain outcomes. We spoke to Darshan Bora, partner, economic laws, practice, and Karthik Mani, partner and leader in Direct Tax South, tax and regulatory advisory at BDO India, on the impact of this on gaming companies. Let's listen into what they had to say.
If you look at it from the perspective of the companies, once an order is passed by the respective authorities, in their case, they will have to file an appeal. And to file an appeal, you have to pre-deposit 10% for the first appeal. And for a second appeal, further another 10% is required. So 20% of the demand requires to be pre-deposited for an appeal. So the cash outflow for that is the immediate. That's going to be an immediate challenge, for the companies. From the government's perspective, if you look at it, most of these companies today are, defunct because already there's a ban on this. So, I mean, it remains to be seen how the recovery is really going to happen in this case. Given that the companies are defunct right now, they will have some assets, but definitely not enough, to make good the liability of GST. So that is likely to be a challenge going forward. And as my co-panelist highlighted, the authorities may then, invoke the powers of recovery against the directors of the company, especially in case of a private company. That power exists with the authorities. So let's see how this evolves.
Absolutely, absolutely. And I think these were 71 companies in total. So, of course, each of these cases will have to be dealt with separately. But let me come to you, Mr. Mani. Mr. Mani, given that gaming companies had earlier stated that interpretation of gambling for GST contradicts Supreme Court's own jurisprudence, how can this be reconciled in today's judgment then?
We need to look at how the government is looking at it, right? The gambling versus skill-based games were more from the perspective of whether the states have powers to ban them or not, right? So the perspective and the purpose of those distinctions is completely different. What the Supreme Court today is saying that let it be game of skill, let it be gambling. It's not a question of whether it's a gambling or skill-based game. It's a question of whether it's an actionable claim or not. In this case, yes, money is invested for actionable claim. The moment you qualify as actionable claim, GST law has powers to levy GST on them. So
that's the word coming in on the landmark judgment that came in from the Supreme Court over the last few days. But shifting focus then, Bharat Dynamics reported weak Q4 largely due to execution timing and a higher base. However, the company continues to enjoy strong long-term visibility with an order book of over 26,000 crore rupees. Meanwhile, LG Equipments reported healthy Q4 aided by strong domestic and automotive demand. Karan is now joining us with the takeaways for both these counters. Karan?
Well, yes, let's start off with the Q4 earnings of Bharat Dynamics, wherein the company has reported a weak set of numbers. While the revenue is down 73% to 480 crores, the EBITDA has declined by 81%. Moreover, the profit is down by nearly 60% and the EBITDA margins have also contracted by more than 500 basis points. The raw material cost as a percentage of revenue is also up from 78% to 113%. Recent update is that the company had recently completed the first of production model of the advanced Akash weapon system. On that note, the company's order book stands north of 26,000 crores with a book-to-bill of more than 7 times. Moreover, the company has guided on the FY27 order inflows to the tune of 15,000 crores. On that note, two brokerage houses are out with a report on Bharat Dynamics, starting off with DAM Capital with a buy rating and a target price of 1,415. The brokerage believes that the revenue was largely impacted due to the supply chain dependencies amid the changes in product specifications, and this is expected to be resolved latest by Q2 of FY27. Moreover, the EBITDA margins also declined sharply, and this was driven by an adverse product mix, negative operating leverage, and a higher R&D expenditure. On the flip side, Motilal Oswal has downgraded the rating to neutral from buy with a target price of 1,150. Shifting focus on the flip side, we have LG Equipment in focus on the back of good Q4 numbers, wherein the revenue is up 12%, EBITDA is up 16%, and the profit is up by 25%. The management has stated that the automotive business also achieved a double-digit growth when compared to the same period in FY25. The global support center timeline has shifted to Q1 of FY27, and the high-margin diesel-powered screw compressor enhancements have been pushed back as far as Q4 FY28. So do watch out for LG Equipments and Bharat Dynamics. Over to you.
Karan, thanks so much for joining us with all those details. Both those counters will be in focus on the back of fourth quarter results. But another stock from the auto sector that will be in focus on the back of fourth quarter results is Ashok Leyland. And they reported strong fourth quarter driven by record commercial vehicle, LCV and export volumes. While GMR Airports on the flip side reported strong volume, revenue growth and EBITDA growth but missed street expectations. Avi is now joining us with more details on both these counters.
Let's talk about two stocks that have come out with its earnings. Starting off from Ashok, Leyland has posted a decent set of numbers with numbers in line with our estimates. They say that the demand for CVs is resilient despite the ongoing uncertainties, and they will focus on selling the commercial vehicles to the Southeast Asian countries next. The margin guidance for the upcoming year is expected to be in the mid-teens as the management says, but the Q1 profitability will take an impact on account of commodity surge. Multiple price hikes are also likely going forward. The price hike in diesel is triggering an interest for EVs across all segments. Talking about the Chennai battery plant, the construction is expected to start in the next 30 to 60 days with it being operational by Q2 of the next year. The defense pipeline is very strong at around 1500 crores and more wins are likely going forward. The exports have taken a temporary dip but are expected to recover in the H2 with a capex guidance of 750 to 1000 crores which will focus on new products and EV. The net cash position stands strong at around 5900 crores. Taking our next stock, which is GMR Airports, had come out with its numbers and has posted a positive PAT for the first time in its decade. They have done debt refinancing by issuing 2100 crores of NCD at 7.6%, which will bring down their interest cost by 150 bips. They have done some big cargo wins at Delhi and Hyderabad airport. And talking about the new revenue streams, the AeroCity won handover by Q2 FY27, and they have signed IHCL as a hotel operator for its Bhogapuram airport. The traffic growth is expected to be in the range of 5 to 7% for the coming year, with the H1 likely to be softer and recovery from H2. The Bhogapuram and Nagpur airports, which have been added, are likely to add 5 million passengers in the upcoming year, with the new tariff determination for the Hyderabad airport, which is expected to be much better. The capex guidance is in the range of 700 to 800 crores, majorly on account of completion of the Bhogapuram airport. The current net debt position stands at 5.5x, which they target to bring down below 4x in the next 1.5 to 2 years.
All right, shifting focus then, Emphasis will continue to remain in focus because the company is now positioning itself for the next phase of enterprise technology transformation, with AI now moving from experimentation to execution. This is what was the biggest highlight of Emphasis analyst meet. Karan is again with us to take us through what the management had to say.
Well, yes, let's take a look at some of the key takeaways from the analyst meet, wherein the EBITDA margin guidance has been maintained in the range of 14.75 to 15.75%. Moreover, the subscription revenue mix is currently in low single digits and the target is 20 to 30% in the medium term. Moreover, the pipeline has grown 4 times in the last 18 months and the large deal mix has improved to nearly 30% in FY26. The average deal size has also increased to $75 million from $54 million, and the company is aggressively targeting vendor consolidation deals to increase its wallet share at blue chip clients. Moreover, the delivery model is shifting from the functional silos to AI-led cross-functional pods. The talent pyramid is moving to a diamond model where AI handles repetitive work. On that note, the management sees brownfield AI integration as a bigger opportunity than greenfield AI. Management has also highlighted 95% of the AI pilots fail to scale due to legacy integration challenges. On that note, the management has said that the margins could have been 200 basis points higher without these investments, and despite the investments, the operating margin guidance has been maintained in the range of 14.75 to 15.75%. Over to you.
Okay, Karan, thanks so much for joining us with all those details. Emphasis clearly will be in focus on the back of that management commentary. Meanwhile, let's also take a look at what Asian markets are doing at this point in time. GIFT Nifty, of course, is suggesting a muted start for Indian equity markets, with Nifty implied open now sitting with a cut of nearly 100 points. We have Shanghai. That index is down 0.2%. Clearly mixed picture coming in from Asian markets this morning. Hang Seng is up 0.3%. Nikkei, that's the Japanese market, that index is up a solid 2% in trade today. But GIFT Nifty is suggesting a muted start. But that's all the time we have on this edition of the show. Thanks so much for tuning in. The market will come up.